So the mechanism in the next slide would be that how to provide these savings to the commercial banks or to the Islamic banks and get on the cheaper mudarba lines in return to the cost-free savings provided to the Islamic banks or the conventional banks. Then in turn, the Islamic banks can develop capacity, governance, financial discipline, and Sharia advisory to the microfinance institution, which is in fact a costly option if such services are procured by the microfinance institutions by themselves. The introduction of the basic and fixed rate products, that is also the part of the phase 1. Then operating through Islamic microfinance union itself. So this is a separate mechanism that if the banks themselves are interested to disperse microfinance, they can create their own Islamic microfinance divisions themselves. In phase 2, the linkage continues and the capacity building for independent operation is provided. So at this phase, the product development and technology transfer are the benefits reaching to the microfinance institution and extension of Islamic microfinance branches by the Islamic banks themselves. If we look at this diagram, so it is a two flow process. The green arrows, they in fact show that the savings of the microfinance clients are being channeled to the Islamic bank, and in return, the Islamic bank is providing mudarba lines to the microfinance NGOs, so that these mudarba lines could be dispersed to their clients. Now, since the Islamic banks are getting these savings free of cost, so that is why the proportion will be fixed. Proportion participated by the microfinance institution and the Islamic bank should be more in favor of the microfinance institution, and such benefit would help them to grow further. In second strategy, so we can talk about inclusion of those who have been excluded because of their poverty. They usually live much below than the official poverty line. So we are talking about the hardcore poor. So in first 2-3 steps, the basic need fulfillment or the social safety nets have to be provided through zakat and sadaqah. In fact, this is a grant that we know. And in this zakat and sadaqah can also be utilized as capital investment. Once the capital investment has been made, okay, and the platform has been provided to the poor people, they can be given the training in the entrepreneurship and the business finance. And then they can be given the interest-free loans, and finally, when they stabilize, they can be offered the profit-based products like murabba and other products. The question of the ownership of zakat, that whether the MFI can use that zakat or can acquire that zakat for the use to develop the poorest of the poor is in fact a question which has been debated by different schools of thought. But one answer or the one opinion is that the ownership of zakat can for this purpose be transferred from zakat given to the microfinance institution and then finally it reaches to the zakat benefit. Now, the third is the cash box model. In cash box model, actually it is the promotion or it is in fact the invitation to the people to build on their social capital, to build on their social Islamic capital and wait for the reward in the world thereafter. So cash box certificate actually provide the opportunity to many people, not only to the rich people, since they would carry the different denominations, not only the rich people but also the poor people would be able to get benefit from this divine reward. So now coming to the products. Many think, okay, we have been listing all and all the products, but I'm just offering, demonstrating that what should be the order of offering the products. Since the clients, the microfinance institution, and the regulators, they all are well versed in credit operations. So in the first phase, Murabaha and Salam, the fixed rate loan, they should be the appropriate products. Then in